All right, welcome to my channel. Welcome to another video. In this video, what I'm going to talk about is how come most people cannot stick to their investment plan? What gets in the way? Things just go awry. Things go messed up. Things just, you're all of a sudden, you're first invested in Apple, but then you're invested 2 years down the line, you have a bunch of shit coins and penny stocks, right? What is it that causes that? It's all in the psychology of how markets make you think, right? You may not think that, you may think it's just your decision, but there are some factors that force you, well, not force you, but they get you to invest into some things that you would normally not invest in, right? So we're going to talk about that today. So in trading, we have to be accountable. As long as the investment thesis stays the same, you got to stick to that plan. So one thing that really affects probably most investors is shiny object syndrome. Shiny object syndrome. What does that mean, right? Well, it means that, say you have your portfolio fully planned out, invested, but it's a little boring, right? You're like, man, I wish I could make more. I wish this investment would start moving, right? It's not doing anything. Then the hype hits, something like a shit coin or that penny stock, that hot penny stock that went up like 20% in a day. Everybody talking about it. Everybody like, dude, you got to get in. And this is where people start thinking, well, you know what? What if I just get out of that investment, play this play real quick, make some money, and then I could jump right back into it, right back into the original investment, right? Say you sold it for a loss. And then you take that investment and you start trading with it. You start buying these penny stocks, these shit coins. You're all involved in the hype, and then it doesn't work out. You end up buying the top and end up losing money. Or even worse, losing all your money. So what did you sacrifice for that hype? You know, what caused you to capitulate that investment that was not violating anything, right? It wasn't violating your risk. You were invested in it because you had a plan. You had a plan of attack. You knew what you wanted out of it. You felt it was low risk. You jumped in. But then at a moment's notice, on the corner of your eye, you just saw that shiny object come out. Now you're trying to chase that. It's all about market psychology, right? You know, otherwise, if everybody invested perfectly, the market would probably never really move, right? So, you know, that's what causes volatility, right? But they get you to jump into this trade and forego your investments. You end up losing money, and worse off, say you never get back into your original investment, even worse, and say eventually it starts trending up. That original investment, that original plan starts working out, but you're not in it. You look at it and you're like, man, I lost money in this hype play. I'm still in it. I'm waiting. I'm hoping. You start sniffing that hopium and you're like, oh man, I need to get this money back, right? But no, it keeps trending down, keeps trending down. You're losing more money. Now it's down 50%. You start getting angry. And then finally you capitulate. Now your original investment is going up in value. And you're like, oh man, that's too expensive. I want it back to where I originally sold it at. And then you look back and you think, man, what did I do? Right? And that's just one scenario that it's very common with investing. So how do I avoid this? How do I avoid repeating these actions over and over that are harmful to me? How do I go about stopping this behavior? First of all, you have to understand that investments can take time. When it comes to investing, every individual is different, right? Everybody is different. Everyone has different time frames, right? Some people are more impatient. Some people are very patient, right? So you can adjust the way you invest based on who you are, right? It's all about creating a strategy that fits you personally, because you will be totally confident and you will have the conviction to stand behind your trades, because you know that as long as you follow your plan that you developed for yourself, you will be successful. And you just let the market do the heavy lifting. And another point I want to point out is that this can take time. Maybe this will take weeks, maybe months, or even years to play out. And this is the competition. This is who you're trading against. People that need instant gratification, jump in and out of hype plays, news events. That's what causes the volatility. As long as you're sticking to your plan and follow that to a T, you'll be all right. You know, I see this constantly. And especially ever since I started teaching the mechanics of trading, right? I don't teach a trading strategy because I don't believe in teaching someone my strategy, right? Because it's all personalized. It has to be tailored to yourself, right? It's like tailoring a suit to yourself. When you see the other side and understand how most people react to when it comes to money and investing, then you can sit back and say, okay, well, if I develop my plan and create a solid plan that I can stand behind, I just follow that to a T. Right now I run a vault, right? It's in crypto and I run it on Ethereum, or I run Ethereum liquidity pools, and it's visible, it's fully transparent. Anybody and everybody can go in and see exactly what I'm trading and exactly what I'm doing. All my activity can be seen. There's no hiding from it. And that's the thing. It creates a level of accountability. I have to be accountable, especially as I'm teaching others a strategy that I'm using, right? And teaching others how to use the mechanics to properly trade. I have to show that I can't be jumping in and out of any hype play that I see here and there, because people will see that, right? And it creates that accountability. And one of my last points I want to talk about is tracking performance. Very important, but not a lot of people do it. People don't take the time to go back and see, okay, what did I do wrong on this trade? How can I have improved on this trade, right? You make tweaks and you hone it and you constantly fine tune it, right? You know, when it comes to investing, it's not set and forget. You have to be in there, not every day, but you know, on a regular basis, just reviewing and understanding what you're doing. You look back on that. How could have I improved on those actions? Very important to track. I'd say this is probably one of the most important things that most people overlook when it comes to trading. If you're not tracking your performance, how do you know how to improve? What to fix? Where'd you make that mistake? You won't. You'll just see results over time and you're just hoping they get better. I know it's difficult. I know it's time consuming, and I know it's something that most of us just don't want to do. And it's especially important to understand, you know, where your mistakes are coming from, because if you don't find them and squash them, you're going to repeat them over and over and over again. And then eventually, if your mistakes are just too much to where like you're constantly losing money because you're FOMOing in stuff, you're selling your investments to get into that hype play, into that shitcoin, and you're just losing money constantly, and then you're calling the market a scam, it doesn't work. And you have to track it and then say, whoa, okay, every time I do this action, I have these losses. Let me stop doing that. That's exactly what tracking performance is. That's all it is. You know, and the best way to do it is just to follow and track each investment individually, and then see what you did, how you performed, what mistakes you made, and track it that way. How you could have done better. Instead of buying it when that investment was going up in value, maybe wait for a dip. Maybe you chased it. Maybe you didn't buy enough, or maybe you bought too much, and just simple stuff like that. And then as you fix those little things, you're like, okay, what's the next thing I can look at now? Right? You don't have to find every single mistake on every trade. You just got to find the glaring ones, the glaring problems, fix them, adjust them, fix that habit, that bad habit over time, and then look for other improvements, you know, other opportunities for improvements, and not having to worry about and depending on and listening to other people. Because like I said before, everybody is different. Everybody has a different plan. Everybody's a different person. Everybody thinks differently about one investment. That's what makes a market. A market is just the opinions of everyone that's in that market. And that's what determines price. You know, who's willing to pay what, who's willing to sell, you know, where. That's all opinions. And that's why when people say or try to time the market or try to, you know, game it and find a strategy that will never make them lose, right, and give them all the wins, doesn't exist. You know, that's just called a Ponzi scheme if it does exist, right? So just saying, like, you can't predict markets. You can only put probabilities in your favor, and you have to follow a plan that you develop for yourself that you can truly stand behind and have conviction. All right, so that's the end of this video. Hope you enjoyed it. Please like and subscribe and leave a comment below. Tell me what you would like to see in regards to the psychology of trading the markets. Thank you very much and have a great day.